Good morning, ladies and gentlemen. Well, after my 2 weeks away, which I very much enjoyed, I am going to do a thorough review and see where we are we'll have a look at every single market and what the spreads are saying about the rest of this year and the beginning of next. And I think we'll find that they are pretty much unambiguous. The score says it all, 89. That's a very high score. I'm afraid the model didn't update on Friday. We'll get that fixed, but it makes no difference because I doubt the score would have changed by a single point. What it's showing by being so high and constantly rising is that every single spread that we look at, and there are thousands in this model, is basically pointing upwards, and the moving averages inside those spreads are all sort of in the order they should be and pointed and trending upwards. This is basically the Goldilocks scenario that the market is giving you, i.e. it's a position and walk away kind of market. Let's start the review of what the bond market is saying, and I think the yield curve is now pretty unambiguous. The 2s10s basically have broken the 75 area, 74, 75 area, and now are in trend towards the 87.5 area, and after that there is nothing until 99 to 100 basis points. What does that imply? It implies that the market is anticipating much stronger growth in 2021, and it's also anticipating that the Fed is on hold for a protracted period of time, and 2s aren't moving. 2s are stuck 15, 16, 17 basis points. Absolutely not moving, and the only thing that's moving is the 5s, 10s, 30s, but especially the 10s and 30s. That is telling me that the inflation expectations are rising, which can be seen from a variety of indicators like 5s. We are basically in a trend, and I doubt that trend is going to stop this side of 100 basis points, something that we haven't seen since early 2017. As to the rest of the spreads, 5s, 10s are beginning to be very interesting because they are showing you a stress point has been reached basically in 5s, 10s. Look at the shape of that spread. I think we are now going to here, 73, 74. That is a big move. It's basically giving you what the expectations of the markets are, i.e. all the way out to 5 years. The yields themselves are pretty stable. 5s are moving very little, and all the stress is taken out in the periods after the 5s. So the 10s and the 30s, and especially the ultras, are taking the brunt of the move. I think there's very little doubt that over the course of the next few months we'll see this 73, 74 area in 5s, 10s. But the one that I think is very, very important to monitor is the 5s, 30s, which on Friday reached the steepest point, 130 basis points. This is really the area that is most concerning. If we now turn this into a weekly, we will see that the real support and the real area of concern is 140 basis points, and this is why I keep on saying that this 140 area is really my Rubicon. If we go through there, I think then that we can have a real problem for risk. So as you can see, it's here, it's 140 to 154. I doubt that we can break it very easily. I think that the Fed will do everything possible to keep the curve contained in this area, because the only thing that can kill a bull market in equities is a bear market in bonds, without any doubt. This is going to be very significant. I can't stress enough how significant it is, because if this starts going through this 140 to 154 area, then we are in for a world of hurt in the in SPX. I'm absolutely convinced of that. The wheels are going to come off at some stage in everything. I cannot stress enough how important that is to me. As long as the 530s stay in this area and the Fed contains it, I'm not too worried. The 5s10s are not too worrying, the 2s10s are not too worrying, but if the 30s start breaking this yield differential, the curve is really going to smack the risk assets about. The weekly chart of TLT actually gives us a very good level to aim at, which is 148.90. That is where we broke up and the the coronavirus panic started. This was a response from TLT, and we are basically going there now that the vaccine is upon us. 148.90, I think the Fed will not be too unhappy with, and they'll try to hold it there, and that might be where when the 530s are at that 140 kind of area. I think that is almost written in stone. At some stage over the next several weeks, beginning of 2021, we will be testing the 148.90 level in TLT. The steepening trend is obvious in Germany too, but you can see how much less so it is. You can have a look at here at the bobble, the 5-year. You can see really it's moved next to nothing in the past couple of weeks. It's right on top of this 75-point line. We have the ECB now. I doubt it's going to move much more, but I think the tendency is for it to go towards this minus 68, 69. It's very, very well contained. If we look at the 10s, the bunds, it's less so, and it's being kept by the expectations of what the ECB is going to do. But I think at some stage, basically, we go back to this minus 39 area, which has been so important. Very contained, and that is why I don't expect the steepening of the States, although it's going to be greater than in Europe, to be that much of a headwind to equities. This is the interesting chart, which is the differential between 10-year in the US and the 10-year in Germany. You can see how it absolutely plunged during the coronavirus crisis and continued to plunge afterwards. And now we are back at the 152 area, which was a bit of a swing point, and headed without much doubt in my mind to 171, which was a bit of support, but eventually I expect it to go all the way back up here to 190, 195 basis points. That's another 40 basis points of differential, assuming that bunds only go 5-10 basis points. That leaves another 40-50 basis points of steepening for the 10-year, and probably quite a bit more for the 30-year. That is going to be very worrying, and without a doubt it's going to test that 140 to 150 area in the 530s. So I think we're going to get there, and how the market reacts to that steepening is going to be the most important thing that's going to happen in Q1 of 2021. It's the risk assets are going to be tested, and especially tech is going to be tested by this steepening at some stage. I have absolutely no doubt. I still think it holds. I think that we will not see inflation expectations take off that much, but the test will be coming. As to the dollar, I think there is very little doubt now that my guess that it was going to accelerate down is correct, and now I think I even have the reason. If your funding calendar for Q1 2021 is very intensive, and you want the market to pay around that 140 to 150 area in the 530s, and you're going to be issuing a lot of long-term paper, and you are reliant on foreign investors to participate, you have to give them a combination of higher yields and a bargain in the currency that you are funding, i.e. the US dollar. The less you want yields to go up, and I think, naturally the US wants yields to remain as low as possible, well, that only leaves one possibility, and that is to cheapen up the dollar and give them a bargain when they do the FX translation. So for me, the trend of the dollar for the next several months is etched in stone. It's going to be down. It's going to be down, and the only question is how hard is it going to be down? Well, I don't think that 88.44 is in doubt anymore. I think that is probably not going to be the bottom for it. I think basically we could get this kind of move that we had from 100 down to 93, from 94 down. It's going to be somewhere around this area. That was, the previous resistance, and I'm going to put in a new line with a new target for me, which is here, 84.50. That is the kind of area that should be a bargain for people to invest in US dollar denominated assets. I think we are going to go there, and we're going to go there PDQ. It just makes all the logic in the world, and it makes all the pieces of the puzzle fit together. If you want to have risk markets which are supported, if you want to have a yield curve which is contained, the only way to achieve that, if you have a very, very heavy funding calendar, is to give them a very cheap US dollar to do it in. Well, if nothing else, we got some very nice levels in gold. The 1765, wish I'd been filled. What can I say? If nothing else, we know that the analysis in gold is correct. The fundamental analysis, which basically says that if yields are to remain contained, the way to do it is by depreciating the dollar. If you allow the dollar to depreciate, gold is not going to be in a downtrend. I don't think we're going to see lower than 1765 for quite some time. I'm naturally annoyed that I didn't pick any up there. I'm at some stage going to be forced to chase, but hopefully I'm going to get some small panics down. If we look at this, to me, on the weeklies, we've basically completed some kind of an ABC correction. We're going to be basing around here, and at some stage we go up. I cannot be bearish of an instrument which is a derivative of real yields and the US dollar. If my view is that real yields, although they're going to rise a little, they're not going to rise a lot. and the US dollar is going to be well cheapened because there is, I think, no alternative for the world than to cheapen it. If that is my fundamental view, then I cannot be bearish gold. I have to be looking for levels to buy. 1810 was a decent level, and 1765 was an absolute bargain. Well done to those who got some within $1 or so. I think that after a brief consolidation, say 1810, 1850, the real signal will be when we start breaking these previous highs here around 1905 and sort of 1900. When we start breaking these levels, I think the trend will have started towards new highs. I don't think there is an alternative to this. Everything that I see points to a bull market in gold developing sometime in the first quarter of 2021, which basically will be a mirror image of the DXY decline. As to equities, well, the only thing that is worrying is that the monthlies and the weeklies are already up above the Bollinger Bands, and nothing good comes from buying the markets too hard above the monthly Bollinger Bands. It never really pays off. It always gives you another chance of buying it back. A few percentage points cheaper. I don't think there is a logic here which says anything but 37.40, which is $170 of forward earnings times 22, is our target. 37.40 is very hard to argue with the market below 37.40. Above 37.40, it's easier to argue with it. I think the trend is very easily up. If we look at the weeklies, we are, unfortunately above those as well, and we are going to be, but as long as we don't keep on breaking anything and just trading very, very slowly and slightly above the Bollinger Bands, we are basically in a period like this where the market just traded up, and was always contained by the lowest moving averages on the dips. Where have we seen a picture like this? These very shallow retracements, always contained by the nearest moving average. Well, where did we see it? Well, we saw it here. This is what it could well look like, and this is basically August. Very, very nice, smooth uptrend, which eventually ends, and you get a nice pullback. I think that we are going, by hook or by crook up to 37.40, and that's why I entitled this thing, you can't really argue with cattle, because if they're bullish, okay, and there is nothing on the horizon, the weakening dollar is a help, which is basically at the moment swamping the higher yields in the bonds, and there is no arguing with them. It's no good trying to be too smart. We are going up, and we could easily get an irrational move beyond 37.40 that people really, feel that they have to participate in because they're underweight or whatever it is. So I think there is very little to be gained in arguing with this move. The technicals will give us the timing. I think that unfortunately we are going higher, probably quite a bit higher. I saw that Kolanovic called for 4,000 very quickly. I can't argue with that. I mean, are we going to be at 22 times earnings or 23 times earnings? How are you going to argue with that logic? You just can't argue with it. If the market wants it 23, it's going to give it 23. If the yield curve allows it, they are going to go and basically, go berserk with it. The only question then becomes is how far they can stretch the tech sector, and we'll examine that in a second. There is no doubt in my mind that the tech sector has been losing leadership for quite some time. It's the only one that it's still within its monthly Bollingers, and the weeklies and the dailies, and it's slowly grinding upwards, but it has lost that impulsive leadership quality that it had. All you have to do is look at the 195 minute chart to see how slowly and how difficult, with what difficulty it is gaining and keeping levels. It's not it's not the sector that I think can lead while the yield curve is doing what it is doing. The only thing that's propping it up is the weaker dollar, and people are being enticed into that, investing into that sector by a combination of a weaker dollar, and therefore the weaker, the less they're really paying in their own currency. But if we look, and I'll do that next, at the individual shares, the FANG shares that have been, sort of responsible for this move, you will see that it's only the second tier stocks that are now trending higher, making this index trend higher, and they're just not big enough to take it to much, much higher levels. They will need, the help of the Microsofts, the help of the Apples, the Amazons of this world, the Facebooks, to really get going. And I don't think that is forthcoming anytime soon. The Blue Angels by Yardeni Research basically say it all. While we are having upward projections to the earnings, it is very difficult to see why the market would be knocked back by anything but a very sharp rally in yields. And if we don't expect that, then all we're really arguing is what the right multiplier is. Is it times 20, times 22, times 24? Well, if the market gets the bit between its teeth, it's going to go to times 24, isn't it? And that's 4K. Do I expect it? How the hell would I know? All I'm saying is that I know better than to argue with it. I would definitely argue with it at times 20. I think if the yield curve is contained, which I would bet it will be, and the dollar is going to be weak, that times 20 is too cheap. Would I say that times 24 is too expensive? Well, it's expensive, but what is too expensive? If there is no alternative, if yields are contained, if the dollar is weak, why would you argue with any level? And that is why I've entitled this, You Can't Argue with Cattle, because they don't see reason. They will first stampede and leave you in the dust, and then they'll reason. It's an unthankful task to stand in the way of this market. The individual shares, the FANGs, are really not a help to NQ. If you look at Apple, basically we have done nothing for months. We are nowhere, and this, it might be tightening, but I don't think it's not a negative chart. It's a consolidation, but I think it can easily last another couple of months. If we have a look at Microsoft, again, just like Apple, done nothing for weeks and weeks and weeks, and will probably continue to do nothing for weeks and weeks and weeks. It's amazing how the leadership from the big, companies like Amazon here has been completely lost. Amazon has not moved since June. that is why I don't think NQ can really keep on, being the leader, and it has not been a leader. Who is the leader? Well, you have the leadership is now CAT. CAT is now taking things higher. That's an industrial. And here we have JP Morgan. This is on a weekly chart, which is now, going up towards the levels of that it started the year 2020 around $140. And that is why XLF has been such a star performer, and that is why, I keep on telling you, avoid tech. There is absolutely not a lot to be gained there, and potentially quite a lot to be lost. These are my spreads against tech. In no way is tech a disaster, okay? I mean, all you have to do is basically look at QQQ against SPY, and this is where we started the year. And what are we? We're just basically holding around the highs. What I'm saying is there's no point holding too much in a sector with much higher volatility if that's not going to pay for weeks and weeks and weeks. Naturally prefer to hold something with lower volatility than tech if this is not going to break out. So really you are looking for sectors like XLF, you're looking for XLV, you're looking for XLI. You lower your risk profile because you never know, there could be an accident in tech because of the higher volatility there. And if XLF, XLV and XLI are going to more or less keep pace and potentially outperform, why take the risk of holding all your eggs in one basket, as it were? I really think that XLF is now a leader. I think XLV at some stage will follow, and I think XLI is slowly turning. It's about time that these spreads, sort of took the leadership role from XLK. XLK is not a disaster. It's not. I'm not forecasting something bad for it. I'm just saying, why hold something with higher volatility if you can hold something with lower volatility and the same performance going ahead in the next 3, 4, 6 weeks? As to the asset spreads, I think there is not much arguing with the direction of things. This is SPY over IEF, new all-time highs, confirming ITOT, IGOV. Not a lot to argue about. Definitely SPY is better than IEF, and it's also not a lot of doubt that we are going up to test these all-time highs in SPY TLT. So not a lot of argument there. SPY performing much better. And also the one that's interesting is here. This is TLT over gold, and this line keeps on being very, very significant. We got there to 1765 and immediately boom, back down. I think this is quite clear to me that this is rolling over, and we will see these kind of levels down there. Therefore, it's quite obvious that the market is saying equities followed by gold, followed by bonds last, i.e. bonds are the ones that you want to own least. And really, if we look at IGOV TLT on a weekly, but especially on a daily basis, it's quite clear that having broken this level and retested it, we are now in a trend. We might have a brief retracement, but the trend is quite clear, and this is what we did, if you remember, in 2016. Throughout 2017 we went higher and then much higher. This is, if you look, let's call that level 2, and where did we finish the trend? We finished it at 260. Okay, you work out the percentages of that and superimpose it here on 290, let's call it. Well, we're looking for a a lot higher. We're looking for at least 10-15% higher relationship between ITOT and the governments. Say the govies stay stable, you're looking for a 10 to 15% move up in equities, easy, over the course of a year. So, there's very little doubt as to what the spreads are saying that you should be holding. First of all, equities, followed by gold, followed by governments, TLT, whatever, last. I'm not going to talk about European equities and the Nikkei. I'm going to talk about them in terms of spread to EEM. Now this is just a weekly chart of EEM. We've reached my target and we are going through it. I think there is very little doubt that EEM is now in a very firm trend. It's an equity. I've been saying that equities are in a bull trend. Why not? But what's interesting is that we are now taking out multi-decade levels. We have an all-time high here at 55.83, which took place back in 2007. I think we will take it out over the course of the next several weeks and months, and we will then have started a multi-decade new bull market in EEM, which takes it a lot higher, probably all the way to 100. Now, why do I think that? Well, I think that because of what it's doing on its spreads. Now, this is a spread of EM against Japan. This is against Germany, and this is against SPY. It is not in doubt at all that we are approaching some very important levels against Japan, and if we start taking out this line here at 80.57, 80.60, we are going to outpace Japan. The moving averages are changing, and you know how bullish I am of Japan. I really, really like Japan, have owned it for a long time, and I think it goes a lot higher. And if this spread, i.e. EM, is going to outperform even Japan, I am truly impressed. This is against Germany. To me, the trend is clear. It's outpacing Germany, and it'll probably go back towards these levels around the 2 area over the course of the next few months. But the one that's really, really interesting is, we've had so many false dawns here in EM against SPY that I really, really think that this is the time. This is the level, 0.14, and I'm really not counting my chickens here, because we are still lower than where we started the year in the relationship between SPY and EM. But I think that the lower dollar, the lower Dixie, the logic of the lower Dixie is going to be what does it here. You can see how important this 0.141 level is. If we start taking that out, then I am convinced that we are taking out multi-decade levels in EM, and we can see a very sharp trend of people panicking into EM and taking it higher by 10% in probably the matter of a couple of weeks. To me, EM is the joker in the pack, which makes perfect sense given that I don't think equities are going to see a significant pullback as an asset class, given where I see them as an asset class against bonds, seeing my view of what the dollar is and what the dollar will be, and the containment of TLT to that 149 area by the Fed, and the spread of around 140, 145 against 530s. If all that matches together, I think EM explodes higher. I always look for charts to confirm or not confirm my view. I need corroboration from all sources. And I think the final nail in the coffin of we're going to have some sort of retracement in equities, no, we are unfortunately going to grind higher, it is this break of 2251 of volatility. We've now had 2 weeks, 2 weekly closes well below it. We've not had that before. It's basically now quite sure that we will trade 1668 at some stage, i.e. volatility is confirming this slow trend, this slow grind higher. And the slow grind higher in equities is made possible by the lack of impulsion from the tech sector. If the big tech companies aren't leading, and it's only the small ones which are, that makes NQ go up by increments of percentage points as opposed to percentage points. And if that's 35% of the SPX, that makes the SPX nice and stable. And if the outperformance comes from F or V or I, which are much smaller sectors, that too makes it much more stable, and therefore volatility tends to trend down. And I think it's quite clear that now we're trending down towards the 1668 level. To me, the 2251 is a pivot level. Below it, everything is good. Above it, bad things tend to happen. And if we have a look actually at tech volatility, this is tech volatility, that also has closed below 3020 for now 4 weeks. So we're not going to have bad surprises out of tech. It might not be as good as, and you can see that we are not closing below the previous lows, which tells me that tech is more vulnerable, and that is why I prefer to have my money in other sectors which have lower volatility but seem to have the same kind of return. And all these charts are basically saying the same thing: slow grind. And in conclusion, this week's sheet, I think I've covered the 2s, 10s and 530s. I put here the new targets and important levels. DXY, can I see this doing anything but going down? I really can't, and I think that is the key. It's gonna go, I think, to 88.44 first, and that's the target I'm gonna concentrate on. Gold, I don't think we'll see 1765. I've put down the logic, I've narrated it to you. I think at some stage we will bust higher, but these are the levels that basically we need to start busting, and I've kept them simple because we're only looking at next week. SPX, I think 37.40 trades, if not next week, then the week after. It's as simple as that, and that will probably be followed by 12,800 in the NQ, which is basically keeping pace but not satisfying the requirements that I have for much better performance for NQ for me to put my money in its much higher volatility. EEM I still love, even though it has reached all the targets from the previous sheets, and you can have a look at those. I think people are still vastly underweight. I've told you what I think of it on a spread to Germany and on a spread even Japan. And I love Nikkei, and I'm convinced that 30k will trade. And if 30k trades in Nikkei, I think we are at 55.83 in EEM without too much problem, and busting higher. XLF, although I am flat, I still like, and I think my final target in the 30s is going to be achieved without too much problem. You know that I have some XLV against XLK. I'm fully invested in equities, okay, so I have my full allocation to equities in any case in my investment account. I have almost no bonds because I think the bonds are the worst. I have a little bit of gold. because I still believe that it's equities followed by gold followed by bonds. I don't like bonds in the slightest. I think the TLT target of just below 150, 149, 149, 148.90, whatever it happens to be, will be seen in the next month or so. Thank you very much indeed, and tweet to you on Monday.